Welcome back to the fourth video of the ETF Masterclass. Now that we know all the important concepts, it's time to go ahead with the fun stuff. In this video, we will discuss the advantages of using ETFs and how you can build your own low-cost and diversified portfolio using ETFs as the building blocks. Finally, we'll provide a framework for selecting the best ETFs. So let's get started. Now, if you're someone who wants to start investing from scratch and build your own portfolio, there are some key points which you need to keep in mind. Number one, diversification. A smart portfolio is a diversified portfolio. Diversification should be done both across multiple securities and asset classes. The importance of diversification cannot be overstated. Second, low cost. Low cost portfolios have a built-in head start. If you bring down the cost of maintaining your portfolio even by 0.5%, that's an extra 0.5% return for you. Number three, rebalancing. Rebalancing is when you adjust the mix of investments in your portfolio to bring it back to your original plan. For example, if you plan to have 50% of your portfolio in stocks and 50% in bonds, and now the value of your portfolio stocks has gone up by 70%, then you would sell some of those stocks to bring it back to the original allocation of 50% each. So rebalancing is making changes to your portfolio based on the situation. So ideally, you would want a portfolio that is well diversified, has a very low cost of maintenance, and is flexible enough to be rebalanced. But why ETFs? Let's talk about some of the advantages of ETFs. ETFs are already diversified. While discussing about diversification, we concluded that a portfolio should be diversified across securities as well as multiple asset classes. With ETFs, you already get the first level of diversification. As an example, an ETF which tracks the Nifty 50 index already has 50 stocks in it. So diversification at a security level is already sorted for you. ETFs have the lowest possible cost. ETFs are cheaper than index funds and are much more affordable than actively managed mutual funds. ETFs are the lowest cost option available if you want to invest in a diversified basket of securities. Here is a diagram that compares the cost for the Indian large cap universe. The average cost of ETFs tracking the Nifty 50 index is 0.14% lower than direct index funds. Now keep in mind that the saved money also will compound for you over time. Also, an ETF-based portfolio is easier to rebalance. Remember, ETFs are traded on the stock exchange, and hence it is possible to execute complete rebalancing of your portfolio in real time. In contrast, an index fund portfolio will require two legs: redemption and purchase. The complete rebalancing can take anywhere between 1 to 3 days depending on the type of fund sold. So these were some advantages of ETFs. However, there are some disadvantages as well. Let's discuss those. Transaction costs associated with rebalancing can be large. There are direct costs related to brokerages. Then there is the bid-ask spread. And then there are liquidity and market impact costs. If not properly managed, these costs can easily exceed ETF's cost advantages over an index fund. This is even more important in the Indian context, where a lot of ETFs have low liquidity. Another significant drawback is the lack of options. The bulk of ETFs in India is primarily tracking large cap indices or gold. Limited coverage for sectoral indices, bond indices, smart beta indices, and international assets hinders optimal portfolio construction. Another drawback is that you cannot do SIPs in an ETF. While some brokers support SIP, most don't. And because of this reason, many argue that a long-term investor should invest in index funds instead of ETFs. Only tactical traders should use ETFs. Now, this statement has its merits. Now, here is the final take on ETFs versus index funds. If you have a relatively smaller size portfolio, say 20 lakhs or below, then ETFs is a better low-cost option for you than index funds. For larger size portfolios, which are exceeding 20 lakhs, index funds would make a lot more sense. That's a wrap for this video, guys. I hope you enjoyed it. And now I'll see you in the fifth and final video of this masterclass. Thank you and bye-bye.